Good morning, traders. Richard here, and a quick Ichimoku cloud chart and artificial intelligence trading review of Palo Alto Networks. PANW.O is the ticker on the Metastock platform. From a big picture perspective, I've got the weekly Ichimoku cloud up here. We can see using the artificial intelligence engine in combination with the Ichimoku clouds. We had a lot of fantastic buy signals here on the chart. You can see tremendous returns here. Using the volatility breakout signal in conjunction with the cloud chart rebound at the bottom in the Ichimoku cloud also give fantastic trade signals there. The last volatility breakout signal here gave 136% return. The trailing stop loss, AI adjusted, the AI trailing stop loss is just below that level there. If I can just get the AI, yeah, 331. It's a volatility adjusted stop loss, so it's pretty wide. The problem with this weekly Ichimoku cloud is we're very extended from the top end of the cloud. You can see the gap here between the price action and the cloud is very wide, so we are moving into high risk territory for Palo Alto Networks here. So don't be surprised if a significant correction comes soon after the results, depending if the results are disappointing or not. But we don't particularly like the price action at this elevated level. Wide price swings is never really a good sign. You want to see narrow and tight price action on a nice sloping trend, not a particularly vertical ascent. But anyhow, it's delivered some really great trades. The one that's one of my favorite here is the major reversal signal here. That is a very high probability trade setup. You can see the trade still on, 115% move in that one, very wide trailing stop. The major reversal, they don't happen that often, so you can really load up on call options, contract for differences, etc. on that particular trade. That particular signal, major reversal signal, is significantly high in high probability of trading success. It does not happen that often, so that was a nice one to take that trade, and one that's also had a lot of comfort in trading that one, because you were back above the top in the cloud and we had a strong uptrend in place. But if we just look at the daily chart here, most recent volatility breakout signals there cross the cloud chart resistance zone. We're back in bullish territory. Price action above the cloud is bullish, and then we had a nice move. Now we're busy with the third move up. If we look at the third move extension, third wave, look what I'm looking for, move, pullback, and this particular move can last up to about 412 to 426, a 38 to 50% Fibonacci extension of this move to the upside. We've just broken out of a double bottom base breakout. The trailing stop, the Fulgent AI trailing stop, is 360 on the daily Ichimoku cloud. You can see how the cloud is supporting the market, as well as the turning line of the standard line Ichimoku clouds, also a nice support zone there. So just broken out of this double bottom base with a third wave higher. So be aware that the upside target is about 400, 412, and 426 based on this particular move off the daily. So in essence, quite happy trading it to the upside with the trailing stop, but I am quite aware that we are moving into high risk, very extended zone on the Ichimoku cloud, and so there is significant risk in the stock. Now let's go and take a look at the deep dive into the fundamentals on a quantitative basis, looking at the StarMine models. These are institutional data points. Hundreds of thousands of data points go into these rankings, and we're going to start off with the earnings quality rank, where you deep dive into the income statement and balance sheet year over year, line item by line item, and StarMine has identified the critical drivers for sustainability and consistency in earnings growth. And unfortunately, Palo Alto Networks fails that. It's in the bottom 20% of the market. Very poor quality earnings. It's underperforming 80% of the market in terms of earnings quality. So there's significant risk in the underlying business. It's really poor quality earnings business. 17 percentile ranking there. So you can see very high risk trade, very extended from the cloud, and also very poor quality earnings, a very poor quality business, basically, so to speak, from an earnings quality point of view. Price momentum scores 84, where we look at price momentum. So it's a purely price momentum stock at this stage. You're not trading it for earnings quality. You're not trading it for quantitative fundamentals. It's a poor quality business, but it's got very strong price momentum. And intrinsic valuation and relative valuation ranks in the bottom 10% of the market. So it's a highly overvalued stock, poor quality earnings, but it's got very strong momentum. So there's a lot of sizzle in the stock price, not so much stake in the stock price. So be aware of that. Combined alpha model where StarMine uses all the rankings together. That's in the bottom 20% of the market in terms of personal ranking. So it's not a particularly attractive stock on a valuation basis, earnings quality basis, but it's a purely momentum play, pure momentum play. Price goes higher, trade it. There's no particular other fundamental reason at this point in time from an earnings quality perspective. Deep diving into the financials, you don't take much comfort in that. So be aware of the fundamental risk. If we just look at the highlights, bull and bear case, short interest is low. Insiders are still selling, earnings quality is low, relative valuation, intrinsic valuation, and valuation momentum score all in the bottom personal rankings of the market. So that is a critical thing to bear in mind. Now, looking at the StarMine estimates, if we just look at how the company's been growing over the last couple of year over year, it's had some significant drops in earnings in 2025, 44% drop in earnings, 39% for the April quarter, and then things started to improve in July quarter. We had a 25% year-over-year growth rate, and then in the October quarter with Q1 of 2026 we had 19% growth, and then January 2026 the second quarter 27% growth, and now the estimate is for a let me see, the 2.4% growth for July, the quarter, so 2024. So be aware that the growth expectations very low. So if Palo Alto Networks surprise to the upside on the earnings basis, then the stock should probably get to our upside targets that we have in that Fibonacci extension. But do know that the expectations are quite low here on the earnings estimate side, and the growth rate is quite low for Palo Alto Networks. So they need to really deliver the strong earnings growth. The thing to remember, if we do a reverse discounted cash flow analysis and we look at the current stock price and feed that into the model, and out pops the growth rates, the market implied growth rate is for 28% growth over the next couple of years per annum. So you can see the earnings growth rate is much higher than the smart estimates, where we track the most accurate analyst estimates. So you can see it's literally many factors of that. So the expectations going into the quarterly results is very high. The next earnings report is due on the 1st of September, so keep your eye out on that. The analysts are expecting a little bit of a predicted surprise to the downside there, negative surprise in earnings, but the revenue should be to the upside. So we do expect a good revenue growth, but low earnings growth there. But overall, Palo Alto Networks is not a particularly attractive stock on a relative valuation or on a combined alpha model valuation or intrinsic valuation basis. So we are trading it purely for the price momentum score, which is very high, as well as the AI and cloud chart signals on Palo Alto Networks. But so far so good. Double bottom base breakout with the upside targets there. Fibonacci extension of this move, the third wave up to the upside, but it's already very extended from the Ichimoku cloud on the weekly basis, so be aware of that. Keep those trailing stops very tight, and do remember this company's got a lot of work to do before it's fundamentally attractive, so to speak. The earnings quality is far too low for it to be a good quality business. Thank you for watching. Until next time, happy cloud chart and AI trading. Bye for now.